Are the various reactions to that big story that we are tracking today, Fitch's downgrade of US Treasury. And that has also sent Asian currencies as well as equity indices across Asia tumbling. Latha Venkatesh is right here to explain the connection. And Latha, why this kind of a reaction across Asia?
Well, first, let's admit that the reaction may be knee-jerk, but it's fairly profound. Look at all the Asian currencies. The Korean won, I'm comparing day on day, 24-hour impact, it's 1.1% down, the Korean won. Malaysian ringgit down 0.8, Filipino peso is down about 0.5%. The Indonesian rupee are also about 0.5%, 0.48. The rupee relatively less actually, but down 0.33. That is still a 3-week low for the rupee. We last saw that on July 10th. Now, impact on Asian equities, again, stronger for others. Hang Seng down 2.5%, Nikkei 2.3%. Korean indexes, Kospi, that is down 1.9%. Taiwanese index 1.85 down, and the Indian index is maximum 1% down. I'm taking an average. Now, how does this work out? The only previous experience we have was when the S&P downgraded US Treasuries on 5th of August 2011. So it's almost to the day 12 years. We are closer to August 5th yet again. Now, what happened at that time was actually the exact opposite. When a currency, when you downgrade a bond, that currency should take a tumble because people move away from that bond. It happens exactly the opposite with the US dollar because people are just afraid of uncertainty. Something is shaking up in the financial market. So what happened in the previous occasion was that over the next 10 weeks, the dollar strengthened. It should have weakened, logically. But it strengthened the dollar index from 74 to 78.50. But that was, it's happened on August 5th. I'm talking about September 30th by the time the dollar strengthened. Accordingly, when the dollar strengthens, EMs weaken. And that's what happened in the previous occasion as well. So one could expect, one should not be surprised by the kind of reaction. As the currencies weaken, people who hold shares in those markets will see their value dwindling, and obviously they also run away from those markets, and that's why you see equity markets also taking a tumble. This of course could be shorting. Now the reaction is expected to be shorter, briefer at this point in time because the world has already seen a previous occasion, and it did after 10 weeks things kind of sorted themselves out, and therefore the reaction may not be much. But the important point is S&P, after downgrading US bonds in August of 2011, has not reverted back to the AAA status. So now it is 2 rating agencies that have put the US Treasuries at AA plus and not at the highest category. And there are some funds which may believe that we take, of the 3 rating agencies, the best of 3, and now 2 have put it as a downgrade. So there is a bit of a kind of a flutter in global markets as to how may funds react. But what we understand from experts is that a lot of funds have rewritten their rules, so much so that a downgrade of the US Treasuries will still keep the US Treasuries as, solid in terms of their rating will not be affected, and the funds may not have to move out of US Treasuries, which is why US yields have not moved up much. They moved up by just 6 basis points from 3.97 to 4.03. But in the days to come, what is expected is, with 2 rating agencies expressing their ire, and it's not just Fitch saying about the debt, ceiling, they're also pulling up the US government for this incessant rise in fiscal deficit, with 2 rating agencies saying that it's possible that the US government, irrespective of what Janet Yellen, Treasury Secretary, says, will not be spendthrift. They will not be, no holds barred in terms of raising their fiscal deficit. If the government spends less, US economy and US equities could take a bit of a breather. So we could see a kind of a medium-term fall, or at least a plateauing of US equities. Anyway, there are rate hikes and a slowdown expected. This will add to the slowdown.
All right, Latha, thanks a lot for taking us through all of those details and explaining to us the kind of reaction that we're seeing across global markets, across asset classes. But with that, we do need to get into a short